Well, good day traders, Chris Weston here, Head of Research at Pepperstone. Now, one of the clear talking points that we've seen from all traders, whether professional traders or whether fairly new to markets, is this very, very low realised and implied volatility we're seeing in G10 and emerging market effects at the moment. There's a number of clear reasons behind that situation, but the question, of course, is will this change and what will cause this to change? And we'll see bigger intraday range expansion coming through in the price action. Now, one of the key talking points about what's caused this is the fact that the Chinese on the 19th of February have identified this reaching out, this olive branch to Donald Trump and the US trade team to keep the yuan stable. And if you have a look at the US dollar against the CNH, the offshore Chinese renminbi, on a weekly chart, you can see it's trading a very tight range and has really done so since that time when they announced they're going to keep the yuan stable. So to see higher volatility and bigger ranges and sort of more whippy price action, explosive price action, we're going to need to see a big move playing through in dollar CNH. I think that there is one of the key currency pairs that we have on our radar. We have to understand that implied volatility in a lot of G10 FX markets collapsed after we saw the Brexit extension going through to the 31st of October. So in G10, certainly in cable and sterling crosses, we've been seeing higher implied volatility. The traders were expecting bigger moves, and as they've pushed that extension out, we've seen volatility collapse again in G10 FX markets. We've also seen somewhat signs of better data. We've certainly seen it in the PMI series in China. We've seen green shoots emerging in some of the data points in Europe, very small amounts. But of course, then we've seen the credit data that's been playing through in China, and that's been very, very strong, both in the January numbers and of course in what we've been seeing in the March numbers. Then we've got positively trending equity markets. We've certainly seen that playing through in China, very strong price action there. We've seen very strong moves playing through in Europe and also in the US, where the S&P looks like it's going to break a new all-time high. Central banks around the world have all moved into a cohesive stance where they're looking at a more dovish structure and potentially opening up the door for interest rate cuts in 2020, and certainly that's the view that we've been seeing from Richard Clarida from the Federal Reserve, where he is seeing the barriers to rate cuts far lower than what we're seeing for the barriers for rate hikes playing forward, and certainly the rates market's been portraying that as well. So certainly this dovish, this universal cohesive stance by central banks all to move to a more neutral or dovish structure has certainly lowered implied volatility playing through there as well. Now, one thing that we are looking at very closely is the US dollar index. This is the US dollar, which is as a basket with about a 60% weighting towards euros. If we do see that breaking through 97.70 to the upside, then I think that volatility in financial markets is going to increase fairly rapidly, and it's the rate of change behind the move in the dollar that's most important there. That said, if we do see the US dollar playing lower, and we're seeing some sort of divergence against the stochastics, and we see it breaking through this recent uptrend, then I think volatility will stay fairly low in this market. But I think a stronger US dollar and certainly a significant break of this ceiling we can see here would have negative ramifications across all asset classes, especially emerging markets, at a time when global growth is still somewhat vulnerable. So the chart that we're looking at very short term is what's happening in the dollar index, and I think if we get an upside break, then volatility will increase, and I think that'll be bad for global growth. That said, a move through this uptrend to the downside I think will be good for risk assets, good for equities, good for emerging markets, and I think we'll continue to see the US dollar selling off, and that will probably coincide with euro dollar trading up to the top of its end of its range at 115.